Welcome back to Stocks with AI, where we analyze the market and individual stocks using data, charts, and smart insights. If you're into stock analysis, trends, well, you're definitely in the right place. Just a quick disclaimer. This is all for informational purposes only. I'm not a licensed financial advisor, so please do your own research before making any investment decisions. Today, we're diving deep into a really fascinating intersection of global forces. We'll explore how recent shifts in trade policy are influencing our economic landscape, and then we'll look at some potentially huge international investment deals that could really reshape opportunities for U.S. companies.
That's right. It's a very dynamic situation unfolding right now. First, we'll take a look at how the markets are reacting to some, well, pretty positive developments on the trade front.
Okay.
Then we'll ground that in the latest hard economic data, see if the numbers actually back up the market's optimism.
Makes sense.
And finally, yeah, we'll analyze these potentially massive investment commitments coming out of the Middle East and figure out what they could mean for specific sectors.
Okay, let's start with trade then. It's definitely been a major headwind for a while, but it feels like there's been maybe a bit of a shift recently. The S&P 500, for instance, it's back in positive territory this year,
Yeah.
and that U.S. agreement with China on tariffs seems like a key factor.
Precisely. That agreement for a 90-day reduction in tariffs, after those talks in Switzerland, that's been a really welcome development for the markets.
Yeah.
The U.S. is lowering tariffs on most imports from China down to 30%. That includes the 20% related to fentanyl, by the way.
Right.
And China's doing its part, too, reducing tariffs on most U.S. goods to 10% and easing some non-tariff restrictions. Think rare earth minerals, for example.
So it's a temporary thing, but it signals maybe a change in approach.
Exactly. It's a temporary reprieve, aiming for a longer-term deal, hopefully. But it signals a potential shift, yeah. Acknowledging that, constant trade friction, it hurts both economies and the global supply chains, too.
And the market response was pretty strong, wasn't it? We saw that rally in stocks. Even interest rates ticked up a bit on the news.
Yeah, it felt like a bit of relief, didn't it, after a period of pretty intense tensions.
Definitely.
It does suggest that despite those earlier really significant tariff hikes from both sides, the U.S. went up to 145% on some things. China hit back with 125%. There's still a willingness to find some common ground.
A recognition that those extremes just weren't sustainable.
I think so. This temporary truce kind of indicates that, yeah, those extreme tariffs, just not a practical way to keep trading, especially between two huge global players like the U.S. and China.
And it's particularly important given the sheer volume of trade between the two countries, isn't it? It's much bigger than, say, our trade with the U.K.
Absolutely. China accounts for what, around 13% of U.S. imports? The U.K. is only about 2%.
Wow, big difference.
Yeah. And exports, about 7% go to China compared to 4% to the UK. So any positive movement, any de-escalation in U.S.-China trade, it just has a much larger potential impact on the global economy, on market sentiment, everything.
So are we past the worst of the tariff uncertainty, do you think?
Well, this de-escalation suggests we might be past the peak uncertainty. Yeah. Expectations now seem to be leaning towards maybe a more moderate average tariff range in the U.S., perhaps somewhere in that 10% to 15% zone.
Okay. And the thinking is that range might cause, like, a temporary bump in inflation, maybe slow growth a bit, but hopefully not pushes into recession.
That's the general expectation, yes. The hope is that growth-supportive policies later in the year could help avoid a more serious downturn.
But still expect some bumps along the road.
Oh, definitely. With negotiations ongoing, we should absolutely anticipate periods of market volatility. That's just the reality, which is why, diversification and a regular portfolio rebalancing are so crucial for investors right now.
Still favoring stocks over bonds overall.
Yes, the recommendation remains to overweight stocks over bonds, particularly focusing on U.S. large and mid-cap stocks.
Okay. Now, alongside these trade developments, we've been getting a stream of hard economic data. How are those numbers looking in the context of all this trade stuff?
Yeah, this is where it gets interesting. Because the recent releases, inflation, labor market, retail sales, have actually been, well, fairly encouraging.
Really? So the trade uncertainty hasn't hit the actual economy too hard yet.
It seems contained so far. The data suggests that, yes.
Okay, give us some examples. What stood out?
All right, so CPI, the Consumer Price Index, headline CPI rose just 0.2% in April. Year over year, that's 2.3%, which is actually the smallest increase since February 2021.
That sounds pretty good.
It is. And core CPI, stripping out food and energy, also up just 0.2% in April, holding steady at 2.8% year over year. Both of those were mostly below what analysts expected, shows moderation over the last 3 months.
Okay, positive on inflation then. What about producer prices, PPI?
Even more encouraging, actually. PPI unexpectedly dropped in April. Headline down 0.5%, core down 0.4%.
Wow, okay.
Yeah. And year over year, both headline and core PPI were also lower than the month before. So that could signal maybe some easing price pressures coming down the pipeline for consumers.
And how are people actually spending? Retail sales?
Retail sales were up slightly, 0.1% over the month. That was a bit below expectations, admittedly. But March's growth got revised upward pretty significantly to 1.7%.
Ah, okay.
There was a little weakness in the control group, though that excludes the volatile stuff. It dropped 0.2%, so maybe a touch of underlying softness there.
And the labor market?
Yeah.
Still holding strong.
Seems to be. Continues to show stability. Initial jobless claims were around 229,000, pretty much in line with expectations and recent trends. Continuing claim is also relatively stable. So yeah, overall the hard data holding up reasonably well.
That's interesting because it kind of contrasts with some of the soft data we've seen, like consumer sentiment surveys, right?
Yeah.
Those have looked weaker.
That's a really important point, yeah. The soft data, like the University of Michigan's Consumer Sentiment Index, it has taken a hit, dropped nearly 30% since January.
Wow.
Yeah, mostly because of those worries about tariffs and inflation. And preliminary May data showed another slight dip, lowest since June 2022. And crucially, a lot of those surveys were done before the U.S.-China tariff pause was announced.
So consumers say they're feeling less confident, but the actual economic numbers aren't reflecting that same level of doom and gloom. How do we square that?
Well, it's not totally surprising retail sales might have softened a bit, given the weak sentiment, especially if maybe some people bought things earlier to get ahead of potential tariffs, front-loading purchases.
Right, that makes sense.
But look at the bigger picture. Retail sales are still up over 5.1% compared to a year ago. And that's supported by, pretty solid household balance sheets, wages are rising, and that steady labor market we just talked about.
So the full impact of higher tariffs and weaker sentiment just hasn't fully hit the hard data yet. It takes time.
Exactly. It takes time to filter through. Businesses might be eating some of the price increases themselves, or maybe they adjusted inventory already. It's not an immediate link.
Okay.
And while trade policy is definitely still a key risk to watch, that expectation of more growth supportive policies later this year, it does offer some hope we can avoid the worst-case recession scenarios.
And the Fed in all this, still on hold.
Yep, the Fed's holding steady for now, keeping policy restrictive while they watch the data. But the general expectation is we could still see maybe a couple of rate cuts later this year.
Especially if the job market softens.
Exactly. If the job market shows signs of weakening, Chair Powell keeps saying they're committed to that 2% inflation target. And it looks like long-term inflation expectations are staying anchored, which gives them some room to potentially ease up if needed.
It's certainly been a volatile ride for the stock market, though. U.S. large caps almost hit bear market territory earlier this year, then rallied back.
Yeah, it really highlights the danger of trying to time the market, doesn't it?
Definitely missed the rebound.
Precisely. Try to avoid the downturn, you often miss the big bounce back. And it's worth noting, globally diversified portfolios, they've actually shown a bit more stability this year. Bonds and international stocks help there.
So with tariffs likely staying higher and those 2017 tax cuts expiring soon, more volatility ahead.
Probably should anticipate continued policy-related volatility, yeah.
So the takeaway for investors navigating this, stick to the plan.
Pretty much. Focus on what you can control. Have that well-diversified strategy aligned with your long-term goals. Rebalance regularly. Spread your investments across different markets, company sizes, styles, sectors, bond types. Diversification is key.
And still overweight stocks, especially U.S. large and mid-caps.
That's the current recommendation, yes. And within higher quality U.S. bonds, favor intermediate and long-term ones.
Okay, let's pivot now, because there's this other massive story brewing, President Trump's recent Middle East visit, and reports of trillions in potential investment deals. This sounds absolutely huge.
It is potentially transformative, yeah, for certain sectors, definitely. His visits to Saudi Arabia, Qatar, and the UAE resulted in some, frankly, staggering announced investment commitments.
How staggering are we talking?
Okay, so Saudi Arabia pledged approximately $600 billion. Qatar pledged around $1 trillion.
A trillion.
A trillion from Qatar, yes. And the UAE around $200 billion, potentially totaling $1.4 trillion just from them.
Okay, My math is failing me. What's the grand total?
The cumulative pledged amount is somewhere in the neighborhood of $3.2 trillion.
Wow. $3.2 trillion. That's immense.
It is. And it's not just the money. The UAE, for instance, aims to build what could be the world's largest data center with NVIDIA and OpenAI. There's a huge strategic element here, too.
Yeah.
These nations are using their capital to buy expertise in technology, especially in AI and cloud, kind of leapfrogging,
And just to be clear, this is new money, right?
Yeah.
Not just shuffling existing funds.
That's a critical point. If you look at what they invested before Saudi Arabia, maybe $200 billion plus. From 2015-2024, Qatar, $60-80 billion, UAE, $50-100 billion. These new pledges are a massive increase. It represents new capital coming in.
Okay, so where's all this potential money going? Which U.S. companies might benefit?
A whole range of them. Boeing is a huge one. Major aircraft orders from the UAE, Qatar, Saudi Arabia. That's a big relief for them. Reinforces their market position.
Definitely needed that.
Yeah. GE Aerospace is looking at maybe $96 billion in contracts for the engines for those Boeing planes.
Okay.
Energy companies looking at around $60 billion in contracts for oil and gas production. Raytheon Defense deals with UAE and Qatar, including drones. Qualcomm, important partnerships with the UAE for an engineering center.
Tech is getting a big piece too, right? You mentioned NVIDIA, OpenAI.
Absolutely. Amazon Web Services is poised to help the UAE build out cloud capabilities, cybersecurity too.
Cloud Launchpad, is that it?
That's the initiative, yeah. Then there's McDermott, Parsons, ExxonMobil and Chevron expecting big investments from Qatar. Volt is building data centers in Saudi Arabia.
And that massive Saudi deal involving computing companies.
Right, that supermicro computer deal, $80 billion, involved AMD, Uber, Google, Oracle, Salesforce, CM2, huge infrastructure focus.
It's a long list.
Yeah.
Any others?
Yeah, Jacobs, AECOM, Renovate and Energy projects, defense contractors generally, maybe Palantir's involved in a big Saudi defense sale, Uber wants to launch autonomous driving there, and there's even talk about Tesla maybe building a plant, given Saudi interest in EVs.
So it's a massive injection for U.S. firms. But what do the Middle Eastern nations get out of it strategically?
Well, quite a lot. They get access to faster NVIDIA chips China can't get right now.
Interesting point.
They get advanced defense tech and agreements. Crucially, their investment buys them access to American know-how, American companies, American expertise. They clearly see technology as the new vital resource.
So they're investing heavily to acquire it.
Exactly. And their capital buys American equipment, strengthening ties. They're making a strategic play to become much bigger global powers, using technology as the lever.
So overall, this sounds like a potentially huge positive for the U.S. economy and these companies specifically.
It represents a really substantial influx of capital into American companies. Yes, some might set up local operations there, but the bulk of the benefit flows back here.
And for specific companies like Boeing, maybe this signals the worst is over.
It certainly looks like a major positive turn for Boeing, yeah. For NVIDIA, it's potentially a massive, reliable future revenue stream. For Amazon's AWS, it really strengthens their hand against competitors like Microsoft Azure in the cloud market.
So putting it all together, this interplay between stabilizing trade policies, pretty resilient economic data despite sentiment wobbles, and then these potentially massive investments, paints a really fascinating picture for the markets.
It really does. The opportunities for growth look significant, especially in tech and aerospace.
It's crucial then for you, the informed investor, to really consider all these developments as you analyze opportunities and manage your portfolio, always keeping that long-term perspective.
Definitely.
What stands out to you most from this deep dive we've done? What questions does this raise for you about where these companies and maybe the broader economy are headed?
Yeah, good questions to ponder.
We really encourage you to continue your own research, dig into the details, and understand the potential impacts of all these unfolding events.
Couldn't agree more. Keep digging deeper.
And don't forget to subscribe and like for our YouTube channel.